Recent reports from mainstream media, specifically CTV and CBC, are finally starting to reflect what many people have been experiencing on the ground in Canada's housing market. And the question now is no longer if something is happening, it's how bad is it and how long will it last? Let's start with a real example. A CBC report recently profiled a home buyer who purchased a pre-construction property about 4 years ago, right near the peak of the market. At the time, prices were surging, competition was intense, and many buyers felt pressure to get in before being priced out forever.
Almeida is desperate. He bought a pre-construction condo just over 5 years ago. Now it's built, but the value has dropped and he can't get a mortgage.
If I did know that this could have happened, I wouldn't have bought the condo.
Like a growing number of Canadians, Almeida couldn't close the deal. He's lost his deposit of about $130,000 and may owe the builder even more.
I thought, we would be okay.
Fast forward to today. That same property has dropped significantly in value by as much as 20 to 25% in parts of the GTA. In this specific case, the buyer is now facing a loss of approximately $130,000. Now think about that for a moment. This isn't just a paper loss. In many cases, buyers in this position may not even qualify for a mortgage anymore, based on the new appraised value. That means they may be required to come up with tens of thousands of dollars out of pocket just to close the deal. And if they can't, they risk losing their deposit, or worse, facing legal consequences. That's one story. But it's not an isolated one. Another report, this time involving a contractor with over 40 years of experience building homes in Toronto, paints an even broader picture. He currently has 6 active construction sites. All of them are on hold. And according to him, there's no expectation that any of them will be moving forward anytime soon. Now, when someone with 4 decades of experience says that, you have to pay attention, because that's not speculation. That's insight from someone who has seen multiple housing cycles come and go.
This building is 30 stories.
Ralph Del Duke has been in the building business for more than 40 years. The head of Chestnut Hill Developments has 6 projects in the works, with digging for the wild slated to begin later this summer.
Here we came to market early last year. We were about 50% sold.
Still, Del Duca says 4 other projects he's planned for this strip of Marley have been delayed.
Well, it's slow, and you have to be realistic about your numbers and how sales go.
Part of a trend representatives from the building industry say show no signs of slowing down.
We're into this cycle right now of cascading record lows.
The Building Industry and Land Development Association says new home sales have seen their worst January for new home sales since they started keeping track in 1981. With 269 homes sold last month, that's 36% less than the year before and a whopping 80% drop from the 10-year January average.
Lowest January on record, and it's following on the worst year on record, which was 2025.
Only 85 condos sold last month, which is a 50% drop compared to last year and down 89% from a 10-year average.
So what does this all mean? Some are starting to say that the market has already bottomed out. But that claim deserves a closer look, because while prices have come down, there are still major forces at play that suggest we may not be at the bottom just yet. For example, inventory. There are approximately 22,000 condo units expected to be completed and released into the Toronto market by the end of 2026. That's a significant amount of supply. And the concern is this: if demand remains weak, those units won't be absorbed quickly. Instead, they could sit on the market, adding downward pressure on prices. Now, at the same time, we're hearing another narrative that because new construction has slowed, or in many cases stopped entirely, there will be a supply shortage in the coming years. And that shortage, according to some experts, could trigger a strong rebound or even a boom by 2027 or 2028. On paper, that makes sense. Less supply plus steady or growing demand equals higher prices. But
come 27, 28, we're going to start to see a shortage of product out there.
If you don't have anything in the pipeline that comes after that, you're looking at very tight supply conditions that will, in the end, drive up cost.
At present, there is a lot of inventory out there, close to 15,000 condos and nearly 6,000 single-family dwellings.
But here's the problem with that theory. It assumes that the system can simply restart when demand returns. And that may not be the case, because one of the most overlooked factors in this entire conversation is labor. When construction slows down or stops altogether, you're not just pausing projects, you're displacing people. Skilled tradespeople don't wait around indefinitely. Carpenters, electricians, bricklayers, drywallers, painters. These are highly transferable skills. And when opportunities dry up in one region, those workers go somewhere else. Right now, that somewhere else is increasingly the United States. Why? Because the U.S. is investing heavily in infrastructure, manufacturing, and large-scale development. There are incentives in place to attract businesses. Projects are being approved and fast-tracked, and demand for skilled labor is growing. So if Canada is slowing down while the U.S. is ramping up, what do you think happens to the workforce? They follow the opportunity, and once they leave, it's not always easy to bring them back. So even if demand returns in Canada in 2027 or 2028, we may not have the labor force needed to respond quickly, which means supply won't just magically increase. It could remain constrained for longer than expected. Now let's go back to those 22,000 condo units. If those units hit the market and don't sell, that creates a backlog, and that backlog can take years to clear, which brings us to a bigger question. Are we looking at a short-term correction or a long-term reset? History gives us some perspective. In the early 1990s, Canada experienced a significant housing downturn. Prices fell sharply, and it didn't take 1 or 2 years to recover. It took nearly a decade for prices to return to previous highs. 7 to 10 years. And during that time, there were periods of stagnation, slow growth, and continued uncertainty. Now, some would argue that what we're seeing today could be similar in scale. Others might even compare it to the 2008 global financial crisis. The difference is, Canada wasn't hit nearly as hard in 2008. In part, that was due to stronger fiscal management and more conservative lending practices. Policies carried forward from leaders like Jean Chrétien and later Stephen Harper helped Canada navigate that period more effectively than many other countries. But today, we're facing a different set of challenges: higher household debt, rising interest rates, affordability at historic lows, and now a construction slowdown. So when you put all of this together, it paints a picture that's more complex than just the market has bottomed. Because even if prices stabilize in the short term, that doesn't necessarily mean a rapid recovery is coming. In fact, what we may be looking at is a prolonged period of adjustment, a market that needs time to rebalance, time to clear excess inventory, time to rebuild confidence, and time, perhaps most importantly, to rebuild the workforce needed to support future growth. So the real question isn't just, has the market bottomed? The real question is, what comes next? Because if history tells us anything, it's that recoveries don't happen overnight. But here's the problem.